Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
Hello, Value Builder community. Today, I'm here with Kevin Bupp, who is a serial real estate entrepreneur, a host of widely popular real estate investing for cash flow podcast, and founder of legendary 72-hour Key West charity bike ride that he used to do. That's a 3-day cycling adventure that he raised hundreds of thousands of dollars. I never had a chance to do it, but I know it was really fun. And today, guys, you will learn a lot. I've been following Kevin for many, many years. I met him first in Collective Genius Mastermind, and we just stayed in touch and definitely learned a ton from his podcast and just following him. So today here for a treat, we're going to dive in Kevin's real estate career. We're going to dive in managing the fund intricacies and his entrepreneur to cyclist philanthropist journey. That's really exciting. And welcome to the show, Kevin.
So it's good to be here, man. Good to see you again.
So first I would like to dive in, and I think we had a brief chat about it, and maybe you can give your perspective about it. So many of our listeners, and myself included, I think they're in the camp that they're not sure if you want to do a fund or if they want to keep buying the properties individually, either syndicating and buying in individual SPs. So when you talk to the folks like you who've been a long time in managing the fund, they say, yeah, the fund is the way to go. The folks who have done it only just buying properties in individual SPs, they say, no, don't do the fund. You're just going to be a manager of glorified fund, and you're going to have a job. And it's just really different perspective when you talk to folks. The way I see it, definitely the fund is much easier to scale, and you're going for the scale, but you're taking lesser slice of the pie. And we're going individual properties. I think the intention is just not for the scale, but just go for most control and most control on the property and equity. But I think there is more to it. So you've been through that journey. So if you can enlighten us, which camp are you on? I think I know, and why, and maybe you can go through the pros and cons. Because we've been doing it for such a long time. I think you did.
Sure.
You've probably done both ways, right?
I have. Yeah, and that's what I was about to say. I mean, we've done it both ways, and there's no right or wrong. For us, we're just wrapping up our fourth fund. We launched our very first fund in late 2016, and are wrapping up our fourth and rolling out our fifth here, literally in the next 30 days. Our typical funds are open, for roughly a 2-year span of time as far as like taking in new capital and making investments. We did have one or two of the funds that were open quite a bit longer than that. But in any event, there's no right or wrong. And honestly, Saul, the structure that we use for the fund, it's very akin to that of what it looks like on, what most folks might understand as a typical, deal specific syndication. Right? I mean, like the documentation is very similar. The difference is that, it's somewhat of at least how we do it, semi-blind. So, while we might have a few identified properties when we launch a fund, in the deal specific, like you've got one property, like it's a known property. It's here's the address, here's the property, here's the business plan. LPs can, maybe easier wrap their arms around that one specific deal. Whereas in a fund, we launch a new fund, we'll always have a couple, what we call seed properties. Like we'll already have a couple deals lined up. We speak to the specifics of those. So there is known information, but really a lot of it is a lot of the future deals that come into there are really built upon what we've done historically, kind of our business plan. And it takes years to build up that trust, right? And so a lot of our LPs, they're somewhat having not blind faith because they've either have worked with us in the past, or we can at least show a track record of what we've done historically. And we just keep doing that same business plan over and over again. And so, our typical fund will have roughly the one we have right now, we're about to close out. We'll close out with 15 properties in it. They typically have anywhere between like 12 and 15 properties that are in them. The current one that we're wrapping up will have I think it will end up right around 200 million of AUM in that respective fund. But I guess backing up a little bit as to why we went this route, right? Again, there's no right or wrong here. And really the dialogue that happened internally when we decided to go from doing individual deals to a fund really revolved around trying to create some logistical efficiencies. Literally now, this is back in 2016 when this conversation originated, and it's because we literally we were very good at finding capital. We were really good at finding great opportunities. And we were good at the operation. We were good at all three of those. And ultimately what occurred is our pipeline, prior to that, we'd do a couple deals a year. But at that point in our conversation internally, we had like 6 deals under contract, and they were all literally going to close in a similar time frame. And these were all mobile home parks. Back then, our average deal size is quite a bit smaller than what it is today, but our average deal size would have ranged from maybe $700,000 to maybe as high as like $2.5 million. And what we started realizing is, number one, the legal cost, just the legal expenses associated with doing documentation for each one of those deals was cost prohibitive. And then just the logistics around the timing of bringing the capital in and allocating it to each individual deal based on the closing time frame of where these 6 deals were in the pipeline. It was just like, I was like, my head was about to explode. I'm like, this is crazy. How about we just make this, let's do a survey with our current investment group that, the ones that had shown an interest of investing in deals. Let's do a survey and see, would they have an interest in just, let's collectively invest in all these, right? Like, let's do it together. There's diversity among marketplaces. There's diversity amongst the business plans with each individual deal. And the feedback was positive, right? And so that first fund was a little bit different because it was kind of, they were assets that were already identified, but they were all going to go collectively together into a fund. And so, some of the big benefits I see for investors is diversity amongst not just assets themselves, but actual markets that these assets are located in. And so, because, the one thing that I always stress on is that there's one truth with any pro forma, and that's, I don't care how long you've been in the business,
Exactly.
how much of an expert you are at your craft. I can promise you one thing. There's one truth, is that the true outcome of that deal, it's never going to mirror the pro forma. It's never going to be exact. It's either going to exceed expectations,
Yes,
or it's going to miss on a few marks, right? Like it's one or the other. And so what we have found with our fund is that inevitably, we've been doing this a really long time, and you always have deals that outperform, and you have deals that, again, not necessarily underperform in a bad way, but they it's not a concise to what you've laid out in the business plan. And so the fund offers a level of diversity and flexibility and kind of combined stability to where if one does better, one does worse, it kind of balances it out. And so we've seen that play out now for many, many years. Obviously, we always try to make prudent, financial decisions. Only, we stick to our guns with regards to being disciplined investors and really staying within our buy box. We know what works really well for us, but again, I can promise you one thing, is it's never going to turn out exactly how you had laid it out on that Excel document. So, that was kind of where the discussion started with, why do a fund versus that of a deal specific syndication. And, we had such great success with that first fund, Saul, that we're like, let's do this again. Like, there's no reason why we wouldn't go this route again. And and what we found over the years is that there's plenty of LPs that haven't invested with us because for whatever reason, like, they just have a much higher comfort level to invest in one single deal than that of a fund, and that's okay. Again, there's no right or wrong, but then we probably have another contingent of our of the investors that are out there that actually understand the benefits, and they see that a fund is better suited for them than that of a deal specific. Because if the deal specific, something goes wrong, there's fewer ways to actually salvage the deal, right? And like, we're kind of seeing that with a lot of multifamily stuff out there, right? Like, one deal goes bad, everyone has a risk of losing money. You've always got a risk of losing money, but you don't necessarily have another deal that can help counterbalance that and pull back up, right? So again, that's kind of why we made that decision. And our fund structure really doesn't look much different than that of a deal specific, as far as like the waterfall structure, the classes that we offer, the GPLP splits, and like, it literally mirrors that of what a lot of folks might see in a deal specific syndication. It's just drawn out on a fund like structure.
Totally makes sense. Yeah, for sure. Yeah, so definitely can see the advocate for that, and I can see the benefits. That one benefit I could see, let's say, that would work in my portfolio. For example, when you have individual syndications, and like you say, some property exceeds expectations and some properties maybe don't meet the mark. And, my rule of thumb kind of to beef up the reserves, 6 months of debt and 6 months of OPEX. And some of the properties have more. Some properties have 12, and maybe another property is just missed the mark and lease up, and we have 3 months. And if you're in a fund, you just probably can take those excess reserves and use there. But if you're in different properties, If you were the same LPs, probably it's okay. If you're different LPs, you can't do it. You have to have permission, right? You can't do the loan to each
That's
other.
right.
You know.
That's right. That's right. I think some other benefits that we have found. Number one, we're a little different than you know, uh, institutional funds. They operate quite differently than how we operate. Institutional funds, literally, they identify a particular asset class, a business model. They go ahead and pinpoint how large that fund's going to be. They're say, hey, we're rolling out a $500 million fund. Then they go out and they do their dog and pony show to family offices, pension funds, and they basically front load the commitments. They'll go out and get $500 million worth of commitments. And then they'll go shopping for deals, and they've got a window of time to actually deploy that capital, and they go out hunting for deals at that point in time. And I think that creates a misalignment of interest to a certain degree. Institutional fund managers, it's much more of a fee laden game. They serve not that they survive on fees. They surely want to get into promote as well, but they still make quite a bit of money even if they never get into the promote. If they can deploy that $500 million, and so. They've got a time frame to do it. Normally, it's not an open window of 5-10 years. I mean, it's like normally like 18 months, 24 months, and so it's a condensed time frame, and so it forces them to go out and maybe sometimes make short-sighted decisions just to deploy the capital because they make money whether or not that deal performs as outlined, because they get acquisition fees, they get asset management fees, and if you're managing a $500 million fund or multiple $500 million funds, you're probably making out pretty well. And so they're going to take the capital and they're going to deploy the capital, whether or not it actually sometimes makes sense to deploy it in particular assets. Whereas we're a little different. We call it it's somewhat of a rolling fund to where we'll earmark. We're going to call this it's a $50 million fund, and a lot of times we'll give ourselves flexibility in the documents to extend it to $100 million if the deals are there and if the money's there, right? And if it's going as planned. So, in that instance, the $50 million fund that we're going to roll out, again, we'll have a couple seed deals to start it off with, and we'll essentially do marketing efforts and capital raise efforts on each individual deal. But folks knowing that they're going into a fund, and so if there becomes like a 4-month span of time where we actually don't have any deals that we're under contract on or that are in the pipeline, then we're not actually bringing capital in to call it down. And so we kind of go through this roller coaster ebb and flow where we put a big emphasis on capital raise, additional capital coming into the fund when we need it. But we don't do it when we don't need it. We don't call it down when we don't need it. We don't bring it in just to have it sitting there idle, not being deployed. And so the average limited partner that might put capital in our fund, either it's going to get deployed right away, but I'd say worst case, they might have to wait 2 months in order for it to get deployed because maybe a deal gets, a closing gets extended or, something delays the closing. But we wouldn't have taken their capital into the queue unless we actually had deals that were earmarked, money hard, and they're going to make it to the closing table sooner or later. And so, again, very different than that of how an institutional fund might operate. And so in that instance, LPs, like their money's getting put to work. We're only buying deals that truly fit our buy box. We're not incentivized to go spend their money just because we have it. We only bring their money in when we need it.
So, that's a really great point. So let's say in your fund, just logistically compared to institutional funds, let's say you raise $50 million for the fund. You don't have properties yet, but you have a buy box. How does the commitment look like for LPs? So you're taking some hard commitments for the $50 million, or you just only relationship-based email? Yeah, we're good for this. How does the commitment looks for your $50 million earmarked?
Yeah. So again, we do it a little different. A lot of funds and there's some legalities, like they'll get commitments made, and then there's actually teeth to those commitments. While the money might not transfer over to the fund, those commitments actually have legal teeth to them. And a lot of them are with big groups, like I mentioned, like pension funds or teachers unions and things like that, right? And so typically they're going to do what they say they're going to do. If they commit, $20 million, when the time comes, they're going to transfer that money over. We do ours slightly different. And again, we only really push for funds when we need them, when we actually have deals. And we've got a trust account set up that's tied to the fund. And basically we pull that money into the trust account. And like right now, that money's earning roughly like 4%. It's basically a high yield savings account. And so we basically earn interest for those funds, the funds that we know we already need. We'll only bring in what we actually need into that trust account. The funds that we know we're going to be able to deploy into deals. And so we don't chase after, written commitments that we maybe got 6 months ago. We only take those as real life dollar. Like if you say yes, then the next step is like you put money into our trust account, you'll earn interest on it, and then we have full autonomy to pull it down from that trust account when we need it over the coming weeks or months, depending on that respective deal that we have to use those funds to
totally
close.
makes sense. Yeah, totally.
So, yeah, and I've seen it done the other way. Like in our retail world, I've seen guys that have followed the institutional model where they're getting, just regular retail LPs to just commit. All you got to do is commit, and then we'll come back to you when we actually need it, and we'll call that down. And I think there's a couple of challenges there. Number one, if we're looking at the institutional world, they're not going out and raising capital from 300 people. Like they're going to go get a couple big whales, a couple big other institutional groups that are going to, commit to 20 million, 50 million, $100 million slugs of capital. Whereas, in the retail world, like you and I operate in, while we might have investors that drop $300,000, $400,000, $500,000, like our minimum investment's $100K, right? And so in any one respective fund, we might have a few hundred investors. And so to think that we're going to have to go chase all those commitments that, someone might have made 3, 4, 5 months ago, I think it's just a little backwards, right? It creates a little bit of internal chaos that isn't necessary. And I think we found a better way to kind of manage and organize that, to bring the capital in when we need it, and already have it at our disposal to where we can then deploy it and not have to go chasing after folks.
And they earn interest based on a 5-year treasury or 10-year treasury, wherever that account is.
That's right. Yeah, right now, I think it's actually just under 4% right now is where I think it's like, whatever, 3.7 or give or take. But yeah, like they're actually earning, or probably actually, it depends where they had it, but if they probably had it in a CD, they had it probably somewhere similar to where it was, actually earning them a similar amount, right? If it was true liquidity that they had just sitting around in one of their accounts that they had access to, they probably weren't earning much more than what we're going to earn them. So it's just, they're not really losing much, even if it takes 2 months for the money to get deployed. In fact, they actually might be earning more if they just had it sitting in a checking account.
Many of my investors, they're just sitting in a checking account doing nothing. Yeah, exactly. I love we going in back, blocking and tackling conversations. I really appreciate it for sharing that. On that note, so you mentioned 200-300 investors. No, we definitely don't manage that one, but I can see with your scale. Do you mind sharing what is your favorite investor management platform? We don't use Jupiter or Investor, but I'm just curious to know what you've probably used many of them, and I don't know if you have a favorite one.
Yeah, so I will just for clarity, there's another principal in our organization named Brian Spear, and so if you bifurcate the company down the middle, and it's not that simple because we got quite a number of other folks on the organization, a leadership team, and all that. But if you truly just cut it down the middle, I'm more on the acquisitions, and then oversee the operations. We're fully vertically integrated on the property management side, and then Brian is more on the capital raising and investor relations side of the house. Again, a little team over there, team over here. And so for that reason, I probably don't have as much detail. I know that we use IMS. We've been using it for years. So IMS was probably the best in class back in 2017 when we actually started using that system. Jupiter wasn't around back then, or Juniper, not Jupiter. Juniper wasn't around, and the many others, right? There's a bunch of others that are out there now that didn't exist back then. There was like 2 or 3 options. IMS was basically the leading the class, and so we instituted that, and we have had, and I think what I've understood from our IR team, we're actually going through an initiative right now where they've been shopping for a new system because, IMS, while they've tried to keep up with the trends, there's functionality it doesn't have, right? And I don't think any one system's the best, right? I don't think anyone does it all, right? Some do these things better than others. I think that we are currently, I don't think we've made a commitment, but I think it's Invest Next or
Invest Next.
I don't know. Like it's one of the. There, yeah, I think that one's made it to the priority list where we might be making a switch. But it's one of those things where you got all these priorities inside the organization, right? Like there's a lot of things going on, and I think we currently have like just shy of 1,000 investors across all of our funds underneath our investment platform, and so it's quite an undertaking. Someone's got to own that project. This isn't like I'll spend an hour or 2 a week on transitioning over from IMS to another platform. Like it is a behemoth of a project. And so the decision doesn't come lightly, and we just haven't made it. Like we've been thinking about it for years. Every year it comes back up, rises to the top. I think this year or next we will make the decision, and then someone on the team will have to, it'll be their dedicated baby, for the next, for a 3-month span to get it moved over. And And when you do that kind of stuff, a lot of things break too, right? It creates internal chaos, and there's no simple like, let's just plug the flash drive over here and everything just carries over and we're good, right? All the information's there. It's
Yeah.
not that easy of a transfer. So, but again, I probably can't speak to any of the nuance with our current platform to that of what we're looking at, because I don't spend any time on that side of our business. But I do know that IMS is the current one, and we're definitely
Yeah,
looking
I don't
for a
have any
change.
horse in the running, but I spoke recently with Fernando, and he's in self storage. Fernando Angelucci, and he's using Invest Next platform. So I know I've heard that platform. But on that note, it's not decision only for yourself. It's easier for you when you say 200, 300 investors. You need to make sure these guys are going to use that, right? And it's that's another
That's right.
adoption, and system works only if the people who use it. A lot of times it's not the bells and whistles, but if you're using it, probably anyone in the system works. And to make sure that 300 people will change and use it, that's another big undertaking. So
Yeah, absolutely. It's got to be an intuitive system, right, for the end user, so they can easily log in and they can navigate it, get the relevant information, for them, quarterly reports, K1s, all that kind of stuff. And so, yeah, absolutely. Again, it's not like those decisions, kind of where we're at the size that we've grown to, they don't come lightly. And it's, that someone's got to raise their hand and say, I own this project. And it's a big one, and it's an important one, and there's going to be a lot
I
of
mean, yeah,
accountability to take that on. And so let's not make that decision unless you're
yeah.
fully committed,
And
right?
And one thought just came into me. There are some investors in my ecosystem that, over a decade, maybe more, they still like to receive paper checks. And these folks actually, the best, they have such a big trust with me and with us right now for the years. They just really don't underwrite or question the property, because they kind of, when you get them the money, they just want to get the money as soon as back as possible without even questions. But if I'll ask them to change the system, that would be a different conversation.
Yeah, absolutely. Yeah, I mean, again, you do your best to
Yeah.
to try to please everybody, and that's a very difficult task to undertake as well. Like, you're never going to make everybody completely happy, and we do not do physical checks anymore. I can't think, I don't know what year it was, but when we went away from that, I'm sure we probably made some folks unhappy. And it's just you have to try to make on our end, like trying to make like decisions of like 3 years from now, like what's it going to take for us to write, if 200
Yeah,
people want physical checks, every month or every quarter, like that's just, we're going to need another team member
exactly.
dedicated to actually doing
Yeah,
that.
yeah.
And
I want to
so,
say we don't write mostly. I have only few folks who still like physical checks now, but yeah, for the most part, we don't do it anymore.
yeah,
Yeah.
yeah, no, understood.
Amazing. But yeah, thank you. Thank you, Kevin, for diving in. Really appreciate that. So next topic I would like to dive in, spotting trends. I know about you from mobile home parks, and I remember you were starting mobile home parks before they were famous and before they were everyone's radar. Then I believe you were starting buying iOS and parking garages. And I remember the conversation probably 6 years ago when I was buying my first school bus terminal. You were just getting in. I remember I was just getting in. iOS was not a hot topic. So I know you as someone who is possibly able to identify trends, even though you're staying in mobile home park for such a long time. But I'm sure you're probably looking at what's going inverted in terms of asset class. The way I see real estate is that, at some point, offices were the most desired asset class, or now it's no, or retail was the most desired asset class, and industrial was on the
Yeah.
bottom, and no one wanted parking spots, and iOS doesn't right now. That's inverts, right? But time changes, and one asset class inverts to another one. Are you spotting? Are you smelling something that something is coming that's going to invert soon?
Yeah, no, it's a great question, a great topic to discuss. To your point of mobile home parks. Yeah, I mean, I've always been in the affordable housing side, even way back, 24 years ago when I started buying real estate. I was always buying, C-class houses and smaller apartment complexes, and so I really understood the need for that product, and that need continued to grow over the last couple of decades, right? And then with COVID, I mean, with where inflation went and where home prices are today, again, the need has always been there for affordable housing, but it's the delta got significantly wider during the last 5 years. And so, mobile home parks are fairly simple and straightforward as far as the demand for them. It's one of our basic needs, shelter, and I do believe that mobile home parks are the most cost-effective, unsubsidized form of housing that exists in any market, not just in the markets we own. In any city, you could take me in across the country. I'll show you a mobile home community that's a better value, better bang for your buck than the comparable apartment that you might live in, and significantly less than that of what whatever the stick-built home would be in that respective area. And our mobile homes are typically much nicer than that of what your standard like B-class apartment complex might be, right? You have a pride of ownership. You've got larger floor plans, more amenities. It's just more of a neighborhood feel than that of having a neighbor above you, below you, or either side. So anyway, I believe in the fundamentals of mobile home parks. Like, it literally hasn't changed. The competition's gotten quite a bit more. I believe in that space today. I believe in it. Believe in it 30 years from now. Like, I do not think that my belief in that asset class will change much at all over the next couple of decades. And so we're going to continue investing in mobile home parks. We've been exploring the ability to potentially find a way to erect some new ones, to build some new ones. That's been quite a barrier for many folks over the last couple of decades. You just haven't seen many new products come out of the ground for a multitude of reasons, which could be a whole show in and of itself. But, mobile home parks just have a bad reputation. A lot of municipalities, they all say they need affordable housing. They want affordable housing. Here's the solution to it. But for whatever reason, they don't see mobile homes as being a good fit for their community, because they think of, the mobile homes that are in the wrong part of town, old metal boxes, unsightly, and just not a good fit for what their community currently looks like. And that's not the case at all. But like, that's perception that they have. And that is the barrier that we've been trying to overcome in our industry for many, many years. And so, we would love to build some new mobile home communities. I still think it is the best unsubsidized housing that exists in any market, and truly will be continue to be the most affordable. But as far as like identifying trends, I just like you, I always try to keep my eyes and ears open to what's happening. I think one thing that we do that I've always done is, way back from when Google Alerts started, I don't know, many years ago, I said Google Alerts for all the big institutional groups. I mean, you got to think about, like, what are they doing? Like, they typically are slightly like, where are they spending their time? Where are they spending their money? What funds have they just recently rolled out? And what are they going to allocate it to? You got to think these are like some of the smartest investors in the country, generally speaking, right? And like, they've got a lot of capital behind them to do research and development, and so just trying to figure out what they're doing, what their intent is over the next couple of years. Where are they focusing their efforts? And so just setting Google Alert. That's simple, right? Set Google Alerts for all the big institutional groups and find out what's the news. Like, what's the chatter amongst those groups, and are they pivoting? If so, why? Into what? What's their investment thesis behind that? And I bet you if you go back and actually look, like you and I were talking about iOS 5 years ago, and if you could go back in time and go research some of the institutional groups that are in iOS today in a big way, and I bet you could probably find some articles that were popping up way back when about this weird. I don't even think it was coined iOS.
It was
not,
no,
yet,
no.
Right? Like, it was just outdoor store. You know what I mean? Like, it didn't even have a name yet, but like, it was getting attention, and there were folks that were eyeing up that asset class. And so I think just paying attention to to what other folks are doing, folks that are, again, that have a lot more time to spend money on research and development, and they've got maybe more access to data points than what the average person like you and I might have. So that's one thing. And then just, again, I speak to parking because that's another asset class we invest in. It's really the two. So and for full transparency of your listener base, I love iOS. I've actually got personal capital invested in a couple iOS deals, more specifically semi-truck parking. As a fund, as a Sunrise, our company, we have parking, but we have no iOS. So we're not in that space. That's not our vertical. The parking that we own inside of Sunrise, inside our funds, is more traditional parking in urban core locations, very strategic locations, but not, it's not akin to that of iOS or truck parking. It's your standard surface parking lot or a parking structure, most of the time in a downtown or tourist-driven area. And so, but the parking stuff came on my radar probably about 7 or 8 years ago, and the reason being is I started seeing a lot of articles about cities that were they were removing their parking minimum requirements from developers. So, developers historically, if you go to develop a new, mixed-use property, condo tower, multifamily tower in any area, they normally would have some type of formula. They're going to require for X number of 1,000 square feet of residential space or whatever space you're building, they're going to require a certain amount of parking, whether that's you need it or not. That's just their formula in order to get it approved. And so what a lot of cities found over the last 3 decades, a lot of downtown areas actually had a surplus of parking because they were forcing these developers to build all this parking that wasn't getting used, it wasn't being utilized. And so over the last 10 years, a lot of major cities now, it's over 100 major cities have removed these parking minimum requirements. So what that's done is developers come in now and they only build what they need. In fact, sometimes they don't even build what they need because there's other ancillary parking in the marketplace that can support whatever use they're putting in. They're going to make way more money by building another condo unit or another multifamily unit than a parking space, right? And so we saw that trend happening. And so we saw this, the data suggested that the parking supply was shrinking in all these markets. And on top of that, municipalities feel very similar about a surface parking lot or a parking garage like they do mobile home parks. They're unsightly to a certain degree. And they typically, if you went in today and tried to knock down a building in a downtown location and said, I'm not going to rebuild something, I'm just going to turn it into a surface parking lot, which is how a lot of surface parking lots actually came about over the last 30, 40 years. They were probably old buildings that at some point someone's like, I'm just done renovating it. I don't see a use here. I'm just going to knock it down. I'm going to level it. And then over years that area grew up and that now flat lot became in high demand for a need to park cars, right? It's very difficult to do that now, to get approval to ever do that again, to build a surface parking lot. And so you're finding the shrinking supply in all these major cities across the country. And so I saw that as an opportunity to get in, just hey, supply is shrinking, and I get maybe in 30 years we're going to be flying around and we won't need cars, right? But in most of the markets that we're buying in, that is not the case. There's a shortage of parking. You can't really build new parking. Developers aren't being forced to build parking. And so I believe there's an opportunity to buy something today that's in high demand, that's on a irreplaceable piece of real estate. So that's another piece of our puzzle. It's got to be the ground underneath the parking garage or surface parking lot. We've got to feel very confident that the actual land value in the next couple of years will surpass the value of it actually being, a cash flowing parking lot. And so we kind of have a plan A, which is cash flow with parking. It's a cash flow covered land play. And we're not developers, so we don't underwrite it as though it has to be developed in order to justify the value. But we know based on the location and what, lots of, parcels of land have sold for, that it will absolutely, without a doubt, have a higher and better use at some point in time. And so whenever the day comes where the highest and best use is not parking, that land will be worth substantially more than what it was when we bought its parking. But until that time, we can just continue to cash flow and have a cash flow covered land play. So that's how we look at parking. And again, we look at way more parking assets to find one that fits our buy box than we do even mobile home parks. Because a lot of parking, a lot of parking was built to really just support maybe an office building or two. I don't know how to fix the office crisis. There's some cities that I think those buildings are going to have to not even be repurposed. They're just going to be torn down, right? And I don't know how to fix that. And so a lot of parking stuff we look at, the numbers are down 50% because this office is half vacant. I can't bet on that. I can't bet on, folks coming back into the workplace and filling that office back up to, levels it was at 10 years ago. And so for that reason, we pass on most parking deals because we're looking for a very wide variety of demand drivers on any parking deal we buy. It's got to have some type of government component. It's got to have a sports facility component, either baseball, football, basketball. It's got to have a major sports arena nearby, art centers, museums, things like that. It's got to be a 24/7 city. So it's got to be a city that literally people are doing something 24 hours a day, 7 days a week. It's not just a 9 to 5 and then on the weekends it's dead. And so we've got all these variety of things and it's got to be a proportionate amount of each. It can't be overly heavy weighted on one to where if that went away, the parking is no longer in demand. So again, we look at 100 parking garages or lots to find one that really fits our buy box. And that's actually historically been the case. In the last 5 years, we bought one parking asset every year.
Yep.
And they've been killing it. But we look at a lot to find a few that fit the box.
I have 2 school bus terminals and we have 2 big parking lots, one in Cleveland, one in Milwaukee, in the metro area. And that has been the easiest development that I've ever done, meaning that if you need to pull permits, put asphalt, you pretty much can be operating within 6 months. And in development, we try to do ground up, right? It's usually 4 to 5 years, 1 year for permits, 1 year for development, 1 year for stabilization, 1 year for refinancing, so, and this was just so easy with the parking lot so far, but it's really, really hard to find. really, really hard to find for outside storage. And on that note, I want to share my thought process on objection. Let's say when I get, okay, what are you going to do when it's going to be driverless? No, truck's going to be driverless because we buy semi trucks. So the way I see it, if it is in the inner city, if it becomes driverless, those trucks with cargo actually they become extensions of the warehouses. If you think about that, if you don't have to have a driver, which is the most expensive thing for the real estate, if your warehouse is so expensive, but you have many trucks who are driving driverless, and they can be in and out, and on 24 schedule, those parking lots actually going to be extension for the warehouses. So actually, the pressure is going to be even more on those warehouses if you can make flexibility as a transportation flexible. So it's not going to go the other way around. Even
Yeah. Well, those trucks, the trucks still have to. The trucks still have to go somewhere, right?
Exactly.
They still have to, even
They have
if
to
there's
park
no
somewhere.
driver in them, they have a physical
Yeah.
footprint. They have to go somewhere, right? They're not just going to be doing circles. Otherwise, you're going to, every city in the country would be so congested, you wouldn't be able to move if these autonomous vehicles stayed on the road
Yeah.
nonstop, right? And so they got to go somewhere. They're going to have to charge. There will still be, maintenance requirements and things like that. They'll have to go somewhere. And so I agree that's kind of my same argument. And time will tell, but I think it's going to be quite a number of years, especially in densely populated urban core locations like where you own stuff, that piece of land will not be in high demand. And even when the day comes, if it's not in high demand of parking, I can promise you, location is everything. So it all goes back to the basic fundamentals. Like if you own a piece of real estate in the right location, high demand, high growth area, inevitably it will have a value of something, whether it's the use today or it's a future use. Inevitably, it will be valuable as something. And so I think just buying the right piece of real estate is really class 101 of buying good real estate.
I want to do a quick plug-in about my newsletter when talking about Google notification. So I have an entire system. I'm writing a newsletter every single week, and there's a section, news and moves and Fed policy, where I just got off before this our pod. I scan probably 50 articles, and pretty much I scan trends. So if someone does not want to set up a Google notifications, you can go on joinvaluebuilder.com and you'll get 2 news and moves condensed from at least 50 articles a week. Fed policy also at least once a week. Yeah, that's easy. But if someone doesn't want to do it, you can just read my newsletter. So that's a little plug.
Yeah, it's beautiful. And I'm actually on your newsletter, so it's good. I really enjoy it. So
all right. So next thing I earmarked what I would like to check is on your podcast. I was a fan for quite some time of your podcast and listened to many episodes and learned a ton. So I just want to ask a question. How much do you think that had impact to your business? If you can correlate, I don't know if there is a way. I'm sure it helped, but was it one of the main drivers of your business, or because you kept it for so many years? This is my 16th or 18th episode. I need to check, but you've been for years, and many people drop off because they don't see the value, and you've been doing that for years. So maybe you can talk to that about your podcast. Now, what's the value to you to your business?
Yeah, sure. And when I started it, I didn't start it as a direct correlation to the business. There was two reasons, or I guess you could say 2 or 3 reasons I started it. The first one was, I was an early adopter of listening to podcasts. I mean, this is I started my show in January 2014. But I'd probably been listening to podcasts for the prior 3 or 4 years, give or take. And I listened to quite a bit. I spent a lot of time on the road, just visiting properties and all that. And back then there weren't many. And there was a couple real estate ones. I think the only one that existed back then that maybe even remotely spoke to some things that were of interest to me was like Jason Hartman had his show way back when. The Real Estate Guys radio show, that was one back then. But most of the other shows, there's a lot of other ones, but most of them were like wholesaling single family homes, like they weren't commercial real estate based. And then, Jason and the Real Estate Guys, kind of a mixed bag, but it wasn't like specific to commercial real estate, which is what I wanted to talk about, which I wanted to learn about. And so I really started because it didn't exist. And I figured as though, well, if what comes out of it, if only two things come out of this is number one, I get to interview some pretty successful folks that I can spend an hour with, have a candid conversation with them, ask them any question I want, and just learn from them, right? Like it's almost like a dedicated hour with a mentor that's been there, done that, earned the T-shirt. And so that was going to be a huge win. And the second piece was like, well, if I'm seeking this information and I have these questions, I'm sure there's at least a couple hundred other people out there in the world that could benefit from this. And so that's literally the reason why I started the show, for that reason only. I didn't tie it to the business. Back then I would talk about the business. Like a lot of times I would just give updates personally, like deals we're working on, challenges we had. If I could find a lesson in what my day-to-day looked like of buying properties or managing properties, I would share it, right? They would just talk about what I have happening. And so what happened as a result of that, Saul, is that, like, I'd say probably like 3 years in, again, I never even promoted the company. I wouldn't mention a website or anything like that. Is I would just, give. And again, I didn't have an intent. The funny thing is my wife used to give me crap about this. When I first started it, I lost everything in 2008. And I started this podcast in 2014, but even then, the years leading out of that, I didn't buy my first piece of real estate again to 2011. I mean, it was absolute chaos. It was a really tough 3 years of my life. I lost everything financially, lost my personal residence. It was just about as bad as it could potentially get on a personal level financially. And so I bought my first piece of real estate again in 2011. And so I was like starting completely over from scratch, literally just trying to create these building blocks again. And so I was at the very beginning stages of kind of my second journey, I guess you could say. And so we didn't have a lot of money. I mean, like we were literally, we had just gotten married in 2010. And so I wasn't in a good financial state. And so every little bit of money on a monthly basis, we had to be very careful about what we spent it on. I remember when I bought the equipment, I had like a couple $100 or something like that. And hosting back then, I don't know, Lipson, it was $20 a month or whatever it was. It wasn't a lot, but I remember my wife saying I would go out in my office every Sunday and I'd spend, she'd go to bed at like 9. I'd go out there and spend like 4 or 5 hours, like producing a show. Because most of my original shows weren't interviews. Maybe half were interviews, but the other half were me. Like I would pick a topic and I'd spend 30 minutes talking about it. It takes a lot of prep, right, to do that. And I'd just be out there till like 1, 2 in the morning, grinding away, producing shows. And, it had we wouldn't go to bed together on Sunday nights, right? And so like after a couple of years, she's like, what the hell are you doing this for? Like seriously, it's just costing us 30, 40, $50 a month. At that point, I'd hire like a VA to help with like some editing and stuff like that. And she's like, we're spending, $50 a month on this. And like, for what? And I'm like, and I didn't know the answer. I didn't actually have a good argument back other than like, I'm learning a ton out of this. I'm learning a ton. I'm meeting a lot of cool people in the process. And then probably by about year 3, of me not really understanding why I was doing it, but I enjoyed it. I enjoyed doing it. And I enjoyed getting feedback from others. I enjoyed the conversations I was having and the value they were getting out of it. So for me, that was enough to keep it going, but I didn't have a bigger picture. And only when I really started getting messages from folks about, hey man, like I keep hearing about these deals you guys are doing. I'd love to participate. I'd love to be a part of it. I got some capital. I don't have your expertise, but I'd love to come into a deal with you guys. And that, I wouldn't say a light bulb went off, but like that was a point in time where we actually started being more intentional about putting it out to the world about what we were doing at Sunrise and the opportunity of potentially working together. And so at that point, we did see quite a bit of opportunity as far as growth in the business, more as it relates to capital, LPs, folks that I wouldn't have met otherwise, right, across the world that now had an interest in investing with us. And so I'd say for the first 3 years, not much. And then probably, from that point for the next 4 or 5 years, it was a major source of where our capital derived from. And mostly because those folks had years and years of listening to me in their ear, right? Like me talking about my family, my personal life. Like I was pretty transparent and they got to know me and they got to trust me, even though they didn't necessarily know me, but they got to know and trust me and allowed us to raise quite a bit of capital and just build a reputation, build a really good foundation to start from. And so it's had a big impact on our business. I think it still does today. I can't give you exact data points of how it ties together. We do our best to track where our investors come from. And now it's been such a long time since we've been doing it. Like they might have heard me once, they might have seen an ad, I don't know, like they might have heard me on another podcast. I don't know if it's directly correlated with my podcast per se, but all I can answer that as is like, it's had a significant and profound impact on me as an individual, first and foremost. Second to that, I do believe that it's had a significant and profound impact on our business and our growth as well, at least in some of the earlier years. So, but I don't have exact data points to support any of that other than I know that a number of folks that have invested with us have learned about us through the podcast. maybe that journey started somewhere before that. I'm not sure, but so and I've had fun. Like I think a lot of folks that start podcasts that, like you see, they get 10, 15 episodes, 20, they do it for a year, maybe a year and a half, and they kind of fizzles out. Is like, it's just having the wrong intent, maybe why you're doing it in the first place, right? If you go into it thinking like, I'm going to go raise capital because that's what another coach out there told me to start a podcast and I can raise capital through it. And if that's like first and foremost in your mind of like why, the intent of starting the show, I think that comes through, right? I think you just have to be authentic and enjoy doing it, have real conversations and be committed that it's just like real estate. It's long-term, right? Like it's a long-term commitment, just like buying a piece of real estate, to think that you're going to get in and get out and you're going to hit home runs every single time. It's just not the case. I think you have to have that long-term vision of buying deals. And guess what? As a default, you're gonna knock some grand slams, right? Like you're gonna hit a couple, but most of them are gonna be doubles and or singles and doubles. Singles and doubles. Grand slam. Didn't see that one coming, but this is great.
You get a home
but you got
run.
to have the long-term vision.
Singles to get a home run.
That's right. That's right.
Yeah, but thank you for sure. I had a hunch that this is going to be the lesson, but I think that's what it is, right? Is that folks who start with that intention because they bought a course and talked to the coach, you're going to raise millions of dollars, they're going to find deals, they fall on their face just because it comes through and it doesn't go, and you start for different reasons. For myself, I think it spun off from newsletter. I had a suggestion from a few folks, but for me, in last handful of episodes, I learned that finally I have an emphasis to connect with people who I really want to connect on a weekly basis, but maybe I'm off in some conference and 2 years later. And right now I have 52 strategic meetings to connect, I would like to talk to all the time, but, we may bump in a conference 2 years from now, but right now at least I have a chance to talk to, that's was really, a big bonus for the podcast for myself.
Absolutely. No, and again, and I think you'll get value out of it. But if you lead with value, the folks that will be tuning in will get gold nuggets every week that you have your conversations. And it's a beautiful thing, you know what I mean? But I think it all goes back to like if you don't enjoy doing it, then inevitably it won't last long term, right? So I think that's why a lot of podcasts tend to fizzle out. I mean, I'd started the second show. You can see if you're watching the video, you can see behind me. We're in mobile home parks. So I started the mobile home park specific show back in 2016, and I had a great time with it. I've released probably 120 episodes or something like that. And I just got to the point to where I was like, this is fun, but I feel like I've run the gamut on the relevant things I could talk about. And lots of stuff that we shared was like very practical, like operational knowledge and things we were doing in the business, which is still relevant today. But I kind of got to the point where I was like, not that I wasn't having fun, I couldn't see the justification to continue on, because everything that someone need to know about investing in parks, they could probably learn by the 120 episodes that were there. And so I felt as though if I kept going forward, I would have just been doing the show for the sake of doing the show. And so for that reason, I tabled it. It's still out there for the world. And that's the cool thing about podcasts. They're evergreen, right? They last forever. And so that information doesn't become stale or old or you can't find it anymore. It gets, hidden on the shelf. Like it's still out there for the world to listen to. It still gets downloads today. I think we still average, a couple thousand downloads a month. And I haven't released an episode for like 5 years or 6 years. Yeah. So quite some time. So, but I still have fun doing the one I do, right? I still love talking to folks like you and just having cool conversations, and I enjoy that. And I get a lot out of it.
Yeah,
personally.
Actually the same thing almost happened with me with newsletter. When I started writing newsletter, I just started from the folks who I have in my database in the email before it started growing organically. My initial reaction, everyone wanted to learn about case studies, the checklist and spreadsheets and how we do it. But yeah, exactly. There is only, 20 or 30 tools in the toolbox. You write about all of them, and then I think people kind of know about it. And right now what I see, people like it just those random lessons, weekly lessons as you go as a commercial real estate guy, not necessarily some sophisticated case study, but something like almost like a perception bender or philosophy. I see this really grabs, and because this is endless. This is just endless how you progress, right? How you progress through to real estate. So that's I caught that feeling, the same thing from my audience.
Yeah, no, and I've read some of your newsletters, and I think the one cool thing that you share is I think you're a critical thinker, and I think in order to make money, especially doing complex or or hairy deals, like you have to be a critical thinker. You have to get really good at critically thinking and thinking of the, variety of outcomes, right? Or the challenges, the multiple challenges you're facing, and strategically think through it. And so I've kind of gathered that from some of your stuff that you put out there, is like you're a really good critical thinker and you share that. And I think some folks are maybe born with that, but I think that's a learned skill that it just comes with time, like of repetition of doing deals, right? Like it just, once you've gone through enough deals, like you've seen a little bit of everything,
Yeah.
or you've seen it sometimes more than once, and it helps you become a better critical thinker when you've got another challenge right in front of you that you got to work through. And so I think I've seen is like, I mean, just like the mall,
Yeah.
the mall projects that you guys have working on. Shit, like that's talk about real
Exactly.
critical thinking. I mean, like you've basically you've spun that entire business on its head when 99% of the investment world are like malls are
No,
dead,
they're not.
and that's the headline: malls are dead, malls are dead.
Yeah.
Maybe in their traditional sense, but like you got to step outside the box, right? Step outside your normal comfort zone, and your thinking zone, and put on that critical hat and think about how. Like, forget about it, what everyone else is saying. Like, where there's a will, there's a way. We just got to think through this critically and
100%.
find a
Yeah,
path.
100%. Yeah.
So,
And that's a good way to frame critical thinking. I think the longer you do that, at least I start analyzing, and okay, is it the right way to think? Just even actually building the models, how to think about it from which direction. That's another way I'm trying to improve myself all the time. Just even how to think about, when you think about from critical thinking perspective, how you're looking at the risk, and from that side, it's yeah. So that's another episode probably could be. All right, that's so
yeah,
amazing. So
exactly.
we're at top of an hour. Normally, I end our episode before we plug in where can people find you. And I know our readers love those answers. And you have a pass if you don't want to answer that. Usually that's with a personal question. So if it's too personal, you don't have to. If you can, please. So if you would be able to ask 25-year-old Kevin for the best advice, if you would be able to give the best advice to 25-year-old Kevin, what would that be?
Yeah, that's a great question. I think the big one is it's one of our core values at Sunrise: enjoy the ride. I think the whole grind mentality. Like, we work our asses off. Don't get me wrong, Saul. Right? Like, we all work really hard. In order to become successful, you have to work hard. But there's also a critical balance of just being so enthralled in your work and down that rabbit hole to where like you lose connection with everything surrounding you, right? And like you lose connection with like the pure feeling of enjoyment and actually smelling the roses and right, and like it's just experiencing life. And so I'd say enjoy the ride, and we try to really emphasize that with all of our teammates, leadership team, all the way down to community managers, right? And just like we're all here to work hard, we're all here to bust our ass and do great things, do big things, but like don't miss what's going on around you. Like, don't miss family moments. Don't miss, taking the vacation, right? Like, cause again, we're never guaranteed tomorrow. Right. And so like, enjoy it while you have it, and don't get so caught up in the minutia of grinding and grinding 24/7 and basically grinding yourself into a dark hole. So enjoy the ride is what I would tell myself. Enjoy the experience, enjoy the time, and, make money while you're doing that,
brother.
but enjoy it.
Yeah, for sure. Absolutely. That's, I want to give the same advice to my younger self too, which is not easy, but that's for sure so true, when you look back. Awesome. So where people can find you if they want to invest in your fund, if they want to be part of your Sunrise Capital, where can they find you?
Yeah. Yeah. So you can learn about Sunrise Capital by going to investwithsunrise.com. We've got quite a bit of info there. You can see our current offering, any future offerings that are coming down the pike. We share case studies. We're pretty transparent with our deals and our business plans. We've got case studies on the website. We've got some white papers as well that we've written about parking investments, kind of our investment thesis there. Mobile home park investments. There's 2 separate white papers you can download. Outside of that, Saul, I'm pretty active on social channels. LinkedIn probably the biggest. And if you just type in my last name, I'm not going to give all the handles, but my last name is Bupp, Bupp. So if you just go to Kevin Bupp on LinkedIn, Instagram, Facebook, I should be the first person that pops up. I don't think there's too many other Kevin Bupps out there.
Thank you, Kevin. I really appreciate that for getting on the show. Looking forward to do it at some point again. And good luck to you. And really appreciate that. Thank you.
So thanks for having me, brother.
All right.
You've been listening to the Value Builder podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.